Let's take a look at this financial forecasting for a new venture. You can see the problem in front of you. Mr. Smith is considering using some funds accumulated in the past in order to start a new retail store. The fixed investment in the store is expected to be $4,150,000. The investment will require no maintenance expenditures for the first 5 years, but after the first 5 years, a $395,000 expense will be needed in order to maintain the facility. The required investment in net working capital is expected to be 24% of annual sales. Variable cost is estimated to be 29% of sales. Assume that there's no taxes and no payables on the business income, so no tax payable. Okay, so what I put together here is a schedule of inflows and outflows based on the information we have. So right now I'm going to call that year 0, and they told us the investment required, which they're considering to be a fixed cost, is $4,150,000. And then we're going to have sales down here. They give us some assumptions. Sales of $1 million, then $1.1 million, and then $1.5 million each year after that. Okay, so I've jotted in all those sales, and I've carried this out for about 10 years, although I think we only need to go 5 or 6. All right, the variable costs are 29% of sales, so just take 29% of sales. And that leaves us the contribution margin, and we're assuming this is all cash, right? Which would make sense. Sales would typically be a variable revenue, a variable type relationship. As we sell more, we generate more cash. Same thing with variable cost. As we sell more, we need to incur more variable cost. Okay, so that gives us the contribution margin per year. The first investment was $4,150,000, and they tell us there's a 24% increase in working capital. Now, I want to point out that working capital is cumulative, is the best way I can describe it. If we have a $240,000 need the first year, which is 24% of sales, if the next year we need $266,400, the only increase in working capital we need from year 1 to year 2 is the difference. So we would take the current working capital minus the last, and then we would keep running this formula, but once we get to steady state and scale sales based on, working capital being 24% of sales, then there's no net increase or decrease, capital increase or release, I guess is the best way to say that. All right, so from there, we can generate what the cash flows are from this project. So at year 0 right now, we've got to invest $4,150,000, and then at the end of year 1, we would have the $710,000 of contribution margin, less the increase in net working capital, which is $240,000, less any expenses, if we had any, and we don't have any maintenance expenses until I believe year 6. Okay, and then we would just copy this formula over, and we can see what the net cash inflows are. Now, we may also want to calculate the cumulative cash inflows to determine break even on a cash basis, right? So we're negative 4150. At the end of year 1, we were positive another $470,000. So if we add the negative $4,150,000 to the $470,000 of positive cash, we're now cumulative negative 3680. Now, I put a 1 down here to say we're 1 year into this. Okay, and we go into the second year, we add the $761,700 of positive cash to the cumulative outflow of cash of $3,680,000. Now our cumulative net cash still negative $2,918,300. I put another 1 to know we're 2 years into this, and now I'm going to sum these at the end. So we keep going through with this same type of formula, right? And eventually we're going to go positive. Okay, so this question says, what's the cash flow break-even point of the venture during the first 5 years? And I think what they're trying to ask us is how long before we break even? And what we see is it occurs somewhere between year 4 and 5 on a cash basis. If we technically wanted to calculate it, what we would do is calculate the partial year for the last year. And what you would do is take the absolute value of the 881,900 that you were in the hole, and then you go positive by 1065. So if we divide 881.9 by 1065, or take the absolute value, 881,900, and divide it by 1,065,000, you come up with 0.83. So it takes us 0.83 into year 5 before we're at break even. Now all I have to do is sum all of those, and I can calculate that the cash flow break even in years is 4.8 years. If you wanted to do this in sales, you would just simply take the sales from every year, right? Every year we're negative, we keep going, and in that last year we're going to multiply it times 83%. So I guess technically what you're actually doing is taking sales times 1. Sales times 1 and then sales times 0.83. And if we add those across, we come up with what the cash flow break even would be in sales. Okay? Let's go on to the next question. Okay, now I slid the screen up just slightly just to read this last question here. And I want to tackle this one, and then we'll tackle the one above it. How much surplus cash is the venture expected to generate each year in the first 6 years? All right, so I think the best way to answer that is just simply look at the cumulative cash inflow and carry it out to 6 years. And at the end of year 6, we're in a cash surplus of $853,100. And that's really how I'd approach this one. Now, the last question says how much of an investment will be required to undertake the project? And I think the easiest way, and maybe one way of answering that is, well, it's going to require the $4,150,000 of the initial cash investment that they told us. And then you've got to consider that net working capital is also an investment, but it's changing over time. So the best way to answer this, in my experience, would be to just take the average. Okay, so how much of the investment would it be? And I'll take the average over 6 years because based on this problem, I think we're assuming it only goes on 6 years based on the questions they've asked. Okay, and so I come up with a 6-year average of $324,400. So I'd say if someone were to ask me what's the total investment required, I would say it's $4,474,400. Now, why am I using the average? Because we don't need an additional working capital in every period. Keep in mind, we only need that incremental. I guess you could also answer it by summing these 3 amounts. And those 3 amounts come out to be $360,000, right? 240, and then you need another 26, and then another 93,600. That's another way you could answer that. So you could answer it as $324,400, or you could answer that as that's the amount of working capital you'd need. Now that gives you $360. Well, that would make sense because you eventually have to get to $360. In fact, maybe that's a better answer than using the average of first 5 or 6 years. Okay, I hope you found this beneficial.